All right, so in this last little bit, what we want to do for year two is now reconcile the cash flow statement. Now, as we looked at in year one, the cash flow statement is essentially out there to track what happened to cash. We started with cash of 6,500 at the beginning of the year and ended up with cash of 25,540 at the end of the year. How did that happen? Okay, well, there's a series of cash inflows, such as borrowing $4,000, outflows, paying for inventory purchases, inflows from revenue. Okay, so buying and selling stuff, buying and selling our land, buying additions to inventory, things like that. These are all the cash flows through the year. Now, this particular company only does revenue, or its sales are all on cash. So far we haven't used the accounts receivable, but we'll get to that in the next year. For the cash flow statement, it's trying to identify what has happened to all the money. Okay, how much money's changed hands, so it can explain how you got from starting with $6,500. Oops. We started the year with $6,500. Added $4,000 from item one. We borrowed money. Borrowing money is a financing activity. We go down here to item number 5. They paid the balance on accounts payable. Now remember, operating activities or anything that's going on here in accounts payable and anything going on in accounts receivable and inventory and anything going on in the income statement. All right, so interest-bearing debt is a finance activity. If we're looking over here, rather than look at all the individual transactions, let's get to the cash flow where we paid net $9,800 for the 11,000 account payable, but we gave back 1,000 of it, so we only owed 10,000. Oh, and we got a $200 discount, so I only had to pay $9,800. That's an operating activity. The $300 shipping cost added to inventory is an operating activity. Our revenue is an operating activity. The cost of goods sold coming out of inventory is an operating activity. The $450 that we had to go pay to ship something is an expense on the income statement, operating activity. The $5,000 SGA we had to pay, operating activity. The $360 we had to pay to ship crap to our customer, operating activity. The $500 that we had from inventory shrinkage, we're just going to call it an operating activity. Same thing as selling it for $0. And then this last one, selling off the land. The selling off the land is a grand total of $6,200, and that's from an investing activity. All right, so if we take the grand sum total here of all these changes plus what we started with, I ought to end up with what's in the checking account, 25,540, 25,540. Okay, so my cash flow balances out. And the reason I want to keep track of whether they're financing activities, operating activities, or investing activities is, we can only sell off all our land so many times. I can buy inventory and turn it over and sell it multiple times during the year. But when I sell off all my fixed assets or my long-term assets, I got no place to do business out of. And I can get positive cash flow from borrowing money, but eventually if you borrow enough money, you'll be paying so much in interest expenses that you won't have enough money to pay your employees and they'll all quit. So we really do want to know from the cash flow statement how much the total cash flow was, but we also want to pay attention to where it came from, because in managing the business, it really mattered where the money's coming from and where it's going to. All right, so that completes year 2, and we'll do a whole different video for the year 3 activities, which will introduce things that happen in the accounts receivable realm.